Hello everyone and welcome to a special week in markets. It's many happy returns for the portfolios here at True Potential, which this week celebrate their 10th birthday, and it's a fantastic story we have to share with you. I'm delighted to be joined by George Bell, Investment Manager here at True Potential Investments. Hello George. And Paul Durrans, Investment Director, focused on the growth aligned funds. Welcome both. We're going to update you on the performance for the quarter just past, Q3, and we're also going to provide a wider backdrop for the year to date. George can speak about the portfolios and the decisions that have been made therein, and Paul can help us with some macro backgrounds. They're all as a part of the celebration for the birthday for True Potential portfolios. So George, let's come to you first. I'll just start with it simply being a remarkably strong quarter for all of the portfolios.
Absolutely. We can see, if we turn to the first illustration, we can see it was a very strong quarter for all risk profiles, balance returning just over 5.5% after portfolio charges in the aggressive model, up 8.1%, so a fantastic quarter for the portfolios. In terms of what our key drivers were, well, the decisions we took as a team were correct in terms of the managers we were leaning into. So our biggest performing manager was Schroders, and this is a manager which we've been building up over the quarter, but actually over the last 18 months for clients as well. Some of the key drivers for Schroders have been their position in gold mining equities. That's been an incredibly strong performer, up around 52% in the 3 months alone. This is an area which they've actually been taking some profits on, understandably, but also some of their more diversified approach towards investing in equities, leaning into markets such as the emerging market space, which has really benefited from a lot of the enthusiasm around artificial intelligence as well. Other managers which have been supportive, UBS, this is one of the largest positions which we have across all risk profiles within our portfolios. It's one of our larger holders of equities within the model, so equities were really rewarded in this period. And again, this is a manager who has been leaning into areas such as the emerging market space, as well as some more nuanced areas such as Chinese technology within Europe, European banks, assets such as silver. So the returns have actually came from quite a broad range of areas, so it's paid for them to be risk on but diversified in terms of the exposure which they've had. And growth aligned, one of our largest allocations in the model, that's been in the top pack in terms of returns delivered as well. So could you give a little bit of context behind delivery?
Yeah, absolutely. For us, it's been very much been risk on, overweight global equities, like UBS being quite diversified, and you've been rewarded for that because different markets have performed well at different stages, but collectively done very well. Being overweight high yield as well, which has been a really strong risk-adjusted return performer. So that's predominantly it, favouring risk assets.
And I should add that one of the tailwinds for the performance obviously was that US equities had their best September in 15 years, so that's helped propel the asset allocation framework we have here. Paul, let's come back to you again just for some context on the economics or the macro which has been driving these positive returns over the quarter, because equities perform well, gold performed well, bonds delivered, so it's pretty much everything is performing really well in this environment.
Yep, it's certainly paid to be patient and to be invested. I suppose coming into the quarter, we were getting the roll-off of the tariff pause, the 90-day pause that came through following Liberation Day. That got extended again, but really tariffs, the concern was that this was going to increase inflation and weigh on economic growth and also corporate profitability. Tariffs actually have, whilst they are evident, they haven't been as inflationary as initially versus expectations, which is a real positive. Economic activity has been far stronger than initially thought. That's thanks to strong consumer spending, but even more so, exceptional levels of capital expenditure on AI.
So the US economy really is booming, isn't it? It's strong,
Exactly.
Strong private consumption. The AI theme, there's a massive capex in there. So the hyperscalers such as Amazon, Google, Nvidia, just massive capital investment, and that perhaps is bleeding across other sectors as well, in as you said, emerging markets, Europe, etc.
I think the key has been the inflation has been more benign than expected, which has allowed the Federal Reserve to restart cutting interest rates. Last year, they cut interest rates by 1%. They then went on pause. They've now started that process again, lowered interest rates last month by 0.25%. Markets love that. They've got lower interest rates, benign inflation, strong growth, and then just to add fuel to the fire, strong profitability. So we've seen good reported earnings, but improving profit revisions as well.
And of course, markets will have one eye on the tax cuts coming next year. So there's another kicker, isn't there, that the one big beautiful bill, those tax cuts come in 2026 and into an environment where there's even lower interest rates.
Exactly.
Tremendous tailwind.
Yeah.
Thanks for that, Paul. George, let's obviously a very strong quarter. We're delighted for our clients in the portfolios. Let's broaden out to the year to date, because it's really a bigger story, which is it's been a remarkably strong year despite the disruption from politics, mainly in the US, and that's been terrific for client outcomes.
Absolutely. Year to date, balanced. We're looking at returns over 9% and in the aggressive model, returns over 10%. So it's been a fantastic period through that time, not without its challenges, but also plenty of opportunities out there captured by, again, managers like Schroders. Gold miners have been a key deliverer in terms of the success which they've achieved. Growth aligned, really the decision which you took to retain your equity overweight through the first quarter of this year was really rewarded, and then your decision to diversify the equity overweight into regions outside of the US has been rewarded, along with some very successful selection in terms of the active products which you've been leaning into. So both of those components have been very beneficial for clients in the portfolios. Growth aligned being an overweight allocation, and Schroders a manager which we've been building the allocation up to.
And that's key, George, isn't it, actually, that the portfolios are benefiting or have benefited in the quarter just past because of decisions you and the team made at the start of the year, which was adding to Schroders. And it might best be worth describing why you added to Schroders, what you were looking for in that allocation.
Absolutely. Our central case is constructive. However, one of the risks that we do see is the risk of a more inflationary environment emerging. And we view Schroders as our key diversifier within portfolios in a higher inflation regime, because it's got less exposure to fixed income. Fixed income would typically be challenged in that type of interest rate hiking or pausing environment. You've got greater exposure to assets such as gold, alternative investment strategies as well, and also less in the more expensive US equity market as well. So a bit more diversification in terms of the asset mix, which we believe would deliver a better outcome in a...
And it's worth tying together 2 points that Paul and yourself have made, which is you were preparing the portfolio for some exposure to upside inflation risks.
Yeah.
But as Paul said, inflation has actually been quite benign, but yet Schroders have still done remarkably well because of that gold exposure, both to physical gold and to the miners.
Yep, absolutely. And this puts us ahead of what a client would have received in an equally weighted portfolio of managers. The tilts which we've taken have added value in that respect.
And that's really key. That's the value add from you and the team, not just running a passive portfolio of equal allocations to each manager within the portfolio. It's actually leaning into your conviction views. You've added to Schroders, as you said. We added to, or the team added to Growth Aligned in the middle of the year when the 7IM funds were closed, and that's all really delivered value.
Absolutely, yeah, and there's been consistency in that approach. We've added to Schroders in our core models, in our plus models, but also in our income solutions as well. So Schroders have had a greater allocation through time in all profiles. In terms of the managers we've reduced, it's been those managers who've either had a higher correlation with our other managers within the portfolio, so we're ensuring that we are driving true diversification in the models, or from 7IM as well.
Perfect.
So rewarded for that.
Well, thank you both. It's a great story to share. A very strong quarter, building on a very strong 6 months before. So that's giving a very strong year to date. It's very much a month of birthday celebrations for the portfolio. So later in the month, you'll hear more from myself and Chris Leyland. And then in November, we'll be able to give an update on performance in the funds relative to the ARC external peer groups, which I know many of you like to see. So we'll bring that to you in perhaps 5 weeks when that data set's ready. But that's all for this week. Thank you. Please do like and subscribe on the YouTube channel. And please join us next week where we'll update you on the latest US jobs data. Thank you very much.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.